Hi, everyone, and thanks for tuning in to our BMO ETFs weekly Views from the Desk podcast. I'm Erika Toth, Director and Head of ETF and Portfolio Consulting at BMO Global Asset Management. And today I have the pleasure of chatting with Andres Rincon, who's Managing Director of ETF Sales and Strategy at TD. Andres has been a collaborator for many years, and today we'll be digging into what's behind the frenzy of ETF launch activity in 2025 and what some of those key trends are. This year has not only been a record year in terms of inflows in the ETF space in Canada, which are at almost $95 billion in terms of net inflows at the end of October, but in terms of new launch activity as well. 2025 so far has seen 367 ETFs launched in Canada as of last week, which is more than the number of ETFs that existed in the full industry when I joined BMO GAM 12 years ago. Andres, thank you so much for taking the time to join us today.
Thanks for having me. Actually, when I started on the ETF desk, there were fewer than those ETFs at all. So it's basically going what the industry was back then every single year now.
Absolutely. So what do you think has led to these record flows and record launch activity that we're experiencing this year, Andres?
It's really two. It's a function of two things from where I sit. Just very broadly speaking, number one, we're always seeing a very strong bull market. And generally speaking, when you have a bull market, you're going to see a lot of interest in your product. There's obviously a lot of assets going into the ETF industry. There's also a big favoritism into the ETF vehicle. So it's twofold. Once again, there's a bull market and a lot of people are getting invested. So you have your traditional advisor, but now more than ever, you have your retail advisor also coming into the ETF space. And as I mentioned earlier, the other part is a transition from the traditional mutual fund industry to ETFs. So on the first one, look, we're getting in a bull market, we get a lot more people invested in ETFs versus, let's say, cash or GICs, et cetera, et cetera. So they put more money to work, generally speaking. And ETFs are a great vehicle, a very easy way to, it's like when you are in a strategy. So they have benefited from a huge interest in this space. Also, since COVID, we've seen the growth of the retail investor really increase dramatically here in Canada and the US. We estimate that closer to 50% of every dollar coming to the ETF industry is coming from a retail investor. And this, I'm talking about the mom and pop trading on their own. So with the growth in the markets, we have increased interest from a large subset of individuals on the street that want to get into investing. So naturally, the ETF structure being the more tax efficient, generally speaking, structure and the more popular structure, we're seeing a lot more interest in the ETF vehicle versus the mutual fund traditional vehicle. So you put those all together, you get, like you said, 367 new launches in Canada, a lot of different issuers that want to defend their turf, a lot of issuers that want to see the almost $500 million a day that's coming into the ETF industry and saying, I want to be part of that growth. And in order to do so, you need to launch ETFs.
I think when I started, there were 6 ETF providers in the country, so it certainly has grown dramatically. This year alone, there are 3 providers in Canada that have launched over 30 new ETFs. BMO is one of those 3. What are some of the types of products launched this year that stand out to you in terms of innovation, Andres?
So yeah, just because you mentioned those 3, I'll stick to those 3 and maybe mention one here and there. But I think it's interesting this year. Like the new kid in the block is definitely the single stock leverage ETF. Those are products that we didn't have before, and we've had some innovations, and I'm sure we'll touch on it from BMO on the cover call side. But something that was not here in the market this year, so last year, that is here this year, is single stock leverage ETFs. These are ETFs that buy a single stock, and you might ask yourself, why buy an ETF that then buys a single stock? And what they do is basically provide exposure to that specific stock with a different investment experience. So in this case, it's cover call, leverage cover call. So you get a little bit more leverage and you get a little bit more yield out of it. So for the most part, investors are going towards this product for higher yield. A good example of this is, let's say you own a tech stock that has no yield. Well, this gives you an alternative to that with a yielding version. So these are very interesting and innovative from from BMO's lineup, I find the call spread cover call to be an innovation, especially in an area like in gold, where generally you don't find cover call. So it is very unique in that the gold space doesn't have, or the commodity space in general doesn't have a lot of cover call strategies, more the fixed income side. But this year, obviously, BMO launched the call spread cover call lineup in ZWGD, and that's a very interesting one because it gives investors upside to the market, and at the same time some yield. So you get some yield, but you're not fully capping your upside, and that's a great advantage of some of these products that they do sell a call, but also buy a further out of the money call to continue giving some of that upside. So I find those very innovative. Other than that, in the street, we've seen a slew of cover call ETFs, as I mentioned earlier, and leverage cover calls. But another big area in the market has been the CLOs, not just from BMO, but for the street. This is an area that is relatively new to Canada, not as new to the US and globally, but has been growing here, has seen some decent activity.
Yeah, so just for the benefit of the listeners, the covered call spread ETF that Andres mentioned, it's ZWGD. That's the BMO covered call spread gold bullion ETF. And for an asset class like gold, that's pretty interesting because gold will tend to trade sideways for many years and then have periods of run-ups. So that is why we decided to structure that one a little bit differently and purchase call options a little further out of the money to provide more upside capture, but still provide nice amount of cash flow in an asset class that doesn't provide any traditionally. So I think that's a good one to highlight. Andres, you also mentioned the CLO ETFs. At BMO now we have 2 CLO ETFs. So we have the AAA rated CLO ETF, which the ticker is ZAAA. We offer that hedged, unhedged, and in US dollar units. And we've also more recently launched BBB CLO ETF, ticker ZBBZ. We've also got hedged, unhedged, and US dollar units for those. And these are interesting because they're a way to access an asset class that previously was only reserved for institutional investors. It's a way to get a little bit more yield out of your fixed income portfolio while maintaining strong credit quality and minimizing the interest rate sensitivity of the portfolio as well. The duration of these are around the 0.1 mark. So these definitely bear a look for investors looking for a little bit of yield and to maintain a good credit quality in their fixed income portfolios. So if we look at the product launches by asset class, Andres, a third of them this year have been index-oriented. 2/3 have been non-index, which includes active, but also quant-based. So by asset class, just over 60% of the launches have been equities. Just under 20% have been fixed income. Alternatives have taken up about 12% of the total launches, and the rest of that is split between mixed allocation products and commodities. So which launches, Andres, have brought in the most significant flows so far this year, looking at asset flows?
Yeah, it's definitely so at the start of the year, it's a bit of a barbell exercise when you look at flows specifically. So it's either strongly on the equity front, especially on the growth front, or on the ultra short end of the curve in fixed income. So those are the ones that have brought most of the money. A lot of people, let me start with fixed income. A lot of people have launched ultra short-term products. Those have been very, very popular in Canada, and they've seen decent interest in the fixed income side. But, like your traditional fixed income product has obviously seen decent inflows, but it hasn't been a stellar necessarily year for your traditional ag product compared to previous years. So a lot of the new launches have been on the ultra short end of the curve, target maturity bond ETFs, and these areas obviously that have been very popular. Now, most of the money really has gone into passive funds, as you mentioned. And most of the launches have been there too, and most of them the assets have gone that way, especially U.S. equity. So whether it's active or passive, funds that have exposure to U.S. equities have generally been very popular. And that you can separate into two fronts. You can say it's your traditional fundamentally active portfolio. This is the traditional mutual fund strategies that's being launched in the ETF share class, let's say. And everybody has their own secret sauce. It's been very popular in mutual fund land. You have an active manager that is giving investors here in Canada exposure to alpha in the US. And those, we are seeing more launches like that, and they're gathering decent interest. The other side of that, we have single stock leverage ETFs that I mentioned earlier. These are considered active at the end of the day, and that the option strategy and the leverage at the end of the day is partly an active exercise. So that's why we categorize them or put them in the active space. Also, they have no index. But these strategies overall are very, very popular too. And these are people that are switching out of their traditional stocks and into let's say, higher yielding environment. Um, Also along the same lines, there's been a lot of launches in the 2x range in single stocks, for example, and in indices too. So that area has grown for a few select issuers, and we've seen money go into that space. Once again, these are all very much high beta um, risk on strategies. So which is why I was saying it's a big barbell, because a lot of this is very dependent on the market. The market's very strong right now, so a lot of interest in higher risk strategies to some degree.
So one thing just to add here, I think it's sorry, I'll retake that. So one thing I like to mention is that within the BMO ETF lineup, we don't use any leverage at all. Andres, I do want to digress a little bit and geek out. In terms of the market making side of things, now that there's more actively managed product around, can you walk the listeners through how the market makers make a market on active portfolios and what's different behind the scenes in terms of your market making process, providing liquidity on the active ETFs?
So actually, there's very little difference between an active portfolio and a passive portfolio in terms of how we make markets on those ETFs. It's more the complexity of what's underlying the basket. There are some extra kinks here and there when you have an active portfolio, because generally they tend to be more concentrated. So we do have some extra steps in place, but really, when it comes to like market making from that perspective, remember that like our systems are all automated. It doesn't know if an ETF is passive or an ETF is active per se. All it knows is what's in the basket of the ETF that we get every single day. So we do not distinguish between an ETF being passive or active. All it understands is that there's an ETF, it has certain securities in it, and this is where we should price it, right? So, and this is important because we do not want to distinguish or separate or somehow highlight one ETF over the other just because it's active versus passive. Now, obviously, active ETFs will tend to be more concentrated. Because of that, it adds extra layers of complexity when you are more concentrated. But for the most part, it would be a similar process. Now, what's really important is that in active, often, not always, but often you will have a lot more complex products in it, and that really is important. So the more complex the strategy, let's say if it uses derivatives, if it uses products or securities that are not tradable. So when you add lack of transparency, lack of tradability within an asset, that's what really increases the complexity of market making in these ETFs. So there is some correlation there as you get more active strategies moving from mutual fund land that are, let's say, have more exotic strategies in them. It becomes more complicated to make markets in these strategies. But let's say you have, just to give you an easy example, if you have an active manager that says, I'm going to actively manage the weight of the S&P 500 versus the just passive S&P 500 ETF. From a market making point of view, there's almost no difference of how we look at those. At the end of the day, the only difference is the weights and who's making those decisions. So there isn't much in terms of difference from a market making point of view.
From your end, though, on active strategies, do the issuers tend to provide your team with a full list of what's in the basket, or is it a representative basket that's sampled?
It does vary, yes, from fixed income to equities. I would say that in equities we would always get the full basket. In fixed income, for the most part, we will also get the full basket. There's very few exceptions and examples of where people do not, issuer does not provide full transparency. Uh, Generalizing, for the most part, we would get full transparency across the board. And it's very important for us to get full transparency. If you know what's in the basket, we actually know how to practice it much better, obviously. So it's to the benefit of the issuer to provide transparency.
Absolutely. Well, that's good to know. So in terms of the active ETFs or discretionary, as the TD research team refers to them as, they've represented about 52% of inflows this year, and are on track to surpass 200 billion in Canadian dollars in AUM by the end of this year. So in terms of active strategies, what are some of the newly launched active strategies that you've noticed getting a lot of traction on your desk?
Um, so in terms of actives, I mentioned earlier, single stock cover call leverage ETFs. Those are active. So they've had a lot of traction amongst retail, crypto. These are, some are active, some are passive, depends on the strategy. So both have some decent interest there. What I'm really excited about, where I think it's slowly growing, is the fundamental long strategies. These have been, your traditional active fund that's very big and large in mutual fund form. This is your traditional, bottom-up manager that is picking stocks. That space has slowly grown in Canada, and as we're seeing more mutual fund issuers launch their ETFs, they're getting to a point where, like, well, I have this very popular strategy. I want to now launch it in ETF format, and now these managers are becoming more comfortable with ETF structure. And because of that, we're seeing a lot more launches of very popular existing strategies in ETF form. And I think that's really exciting, because that's really tells us about the maturity of the ETF structure, where, like, if you manage money in a large fund, you're basically now having to move to the ETF structure to get more or look for growth. So this tells us that ETF structure is the way to go, and this is where we're seeing most of the money go towards, I would say.
So let's shift gears and chat about the latest alternatives launches. So as we mentioned, this represents about 12% of new launches so far this year, but it's definitely an area that's growing. What kind of strategies and exposures are you noticing on the alternative side of things?
So it's twofold. Here in Canada, crypto ETFs are alts. They're liquid alt products. They're filed under liquid alt. And that's how the regulators wanted it from the start. So because of that, they are put into the same bucket, and they've seen tremendous growth. If you look at the US, the most successful launch in ETF history is IBIT, which is their crypto ETF, their Bitcoin ETF. Canada was the first country to launch many of these ETFs, the first Bitcoins, first Ether, first Solana. And these ETFs being here first often get a decent amount of attraction. They also are a good place for Canadians to invest in Canadian dollars in these strategies, for example. So they have gathered some interest in this space. And this is across XRP, Solana, Ether, and whatnot. So specifically this year, it was Solana and XRP, obviously. So we've seen some momentum there in those ETFs, including obviously IBIT that launched this year. Other than that, it's been a little bit slower this year, but we're seeing a lot of the global macro funds, long short strategies come into the ETF space. So we've seen a couple strategies like that. I would say there's a handful of those, and some of them have been very popular. Some of them haven't as much of the new ones. So it just really depends on the issuer and the strategy, but we're seeing more of those strategies coming to market. I think a big phenomenon is adding new strategies or launching them in an OM fund has become quite hard for some of these issuers to gather assets to get them approved across the different banks and different investment houses. So a lot of these strategies and a lot of these issuers are now looking to the ETF structure maybe as an easier way to reach the assets. So it's become an interesting space because some of these strategies that could potentially be offered in OM or as an offering memorandum, and they're a lot more complex. These strategies are now being looked to launch in ETF form, and sometimes they're maybe too complex for ETF form. So we're seeing that balance right now, where some issuers are finding the way to launch it in ETF form, and that way get more access to the advisor directly, given that they couldn't as an OM fund. So those are a
And
couple of the areas on the alt side.
couple that I would highlight from our lineup. So even though they weren't launched in 2025, but I would put them in the noteworthy launches for sure in the alternatives bucket would be the ZLSU, which is our long short US equity ETF, and the ZLSC, which is our long short Canadian equity ETF. And these provide a great way for Canadians to get market-like returns, but with about half the level of beta. So I would definitely put these on the noteworthy list in terms of recent launches.
Yeah, and there aren't that many funds in ETF form that are competing in that space today. It's like there are a couple issuers there, and what I really find interesting about those two products you mentioned, their simplicity, the low cost that they offer to and investors here, and obviously the low correlations, generally speaking. So they're very interesting in this space.
That actually brings me to my next question. That's a great segue. There's been a lot more focus on total cost reporting across the industry. Andres, are you starting to notice a downward trend or a trend towards more competitiveness on the levels of management fees out of the new products being launched? Do you have an average management fee figure in terms of the new launches that we've seen so far this year?
Yeah, so we have seen, for starters, I would say that's still early days. Like CRM3 hasn't really come fully online, so I don't think every single issuer has reacted. Some being smart have started to do so. So BMO lower fees. Some of your competitors also lower fees in some of the new products. There was a competitor of yours not long, like, they're off the board. So we're seeing more and more issuers lower their fees, but I think a lot of it is to come, if I'm honest. When the actual full numbers are reported and everybody sees the outliers of who's really high, I think that's when you're going to get a lot of people starting to cut their fees, if that makes sense. In some regard, the industry will be reactive to this and how the advisor, the end client, will react to the higher fees if there are any. But for starters, we have already started seeing some of the more cost-conscious issuers, such as BMO, start cutting fees for their clients in advance of CRM3 coming in. Now, I think the biggest worry is obviously for the higher cost issuers, and like I said, a lot of that will perhaps be reactive at some point. Now, I already mentioned that we've seen a small, like a slow migration towards lower costs. Generally speaking, the new products that we've seen have been more on the active side, like you mentioned yourself. Like most of the launches this year have been in active space, so the active ETF generally has higher fees than the average across all ETFs. So I think the average mean is around just shy of 50 beeps, and the average launch this year is in the 50 beep range. So call it on par with the average, but bear in mind, most of the launches this year, once again, are in the active space. So I find that really interesting. We are seeing active come in a lot cheaper and a lot more pressure there. One thing that I'll highlight is that when it comes to trends within our channels, we're not necessarily seeing a huge move within like ETFs are obviously already low cost. What we're seeing is a lot of people that have a higher fee existing product in their portfolio, looking to the ETF structure for a cheaper version of that same strategy. So we're seeing a lot of that. We're getting a lot of questions. We're getting a lot of questions on how do we lower the average cost of a portfolio without necessarily significantly altering our strategy. So I think you're going to see a lot of that. People clearly are married or love their exposure that they have. They've probably thought about their portfolio allocation quite a bit, and maybe we will be incentivized to change just because of fees. Obviously, performance is very, very important, and that's why you allocate to such and such asset class. But if you can get that same exposure or similar exposure in um, at a lower cost, that's where a lot of advisors are having interest. So we are seeing many of our advisors start asking about uh, maybe I want to cut a certain percentage of this portfolio into a lower cost portfolio. What would it look like? What are my alternatives? So we're getting a lot of those questions, and that naturally leads to switches out of X, Y, and Z to ABC. And some of these might be ETF to ETF or mutual fund to ETF or OM to ETF or whatever it is. But definitely what's key, and we can see in the flows, is at the other end of the spectrum, on the side that's getting the inflows, is the ETF structure. Why? Because it is the lowest, most cost-efficient structure out there. So the ETF industry is very well positioned to see some of these benefits of CRM. Now, once again, just because you're an ETF structure doesn't mean that you're going to have a very low FER, of fund expense ratio. There are strategies within the ETF structure that will have higher costs, and that's once again dependent on the complexity of the strategy. So if you have a very complex, very active portfolio, and you're trading in and out of it in products that are expensive, then that will show there. A good example of that is crypto. Crypto tends to be expensive. Custody in crypto is very expensive. Trading in crypto is expensive. Now, not all these costs will show up in the trading expense ratio, because some of these costs are spreads. The spreads are not captured. And this, for example, in fixed income, if you have it's just spreads wide and then you trade in and out of that, those are not captured as part of the trading expense ratio. It will only be really trading commissions that you will see there. So it is tricky when you're comparing across asset classes, but generally speaking, the ETF structure is better positioned than most of the other ones. So we should see a migration there.
So just for the benefit of some of our listeners who might not be familiar with some of the total cost reporting changes that are slated to come up in the beginning of 2027, I just want to give a quick rundown there. So there's going to be more transparency, and costs are going to be shown to investors on a more granular level. So for each fund or ETF that's held within an investor's portfolio, they're going to be seeing, as of January 2027, the MER of a fund, as well as the TER, which is the trading expense ratio that Andres mentioned. So this is what it costs the portfolio managers of that particular strategy to trade all the underlying securities in that ETF. And the total of those two is going to be referred to as the FER, which is the fund expense ratio. So I just wanted to give a little bit more detail on that. Those changes are going to be coming up. So a lot of providers now are taking initiative to educate investors around that. And I'm really proud to say that within the BMO ETF lineup, that we're consistently in the lower bands of the average costs across the industry. So I do agree, though, with what you're saying, Andres, in terms of, whether a client's going with an index-oriented strategy, a quant or systematic strategy, or a full-blown active strategy, the costs will tend to be a reflection of the complexity of that particular strategy. And I'll also summarize, the flows that we've seen so far this year, not necessarily just the new launches, but in terms of what ETFs have been the most popular and attracting the most flow. If you look at the top 20 most purchased ETFs in the industry so far this year, as of the end of October, the average MER on those is about 22 basis points or 0.22%. So definitely shows, an appetite for low-cost strategies. And I think that ETFs will continue to deliver on this.
Yeah, and
So any thoughts? Sorry,
what I wanted to add really quickly on that is that, like, using just your lineup as an example, like you can build a balanced portfolio of sorts, global if need be, for like 8 beeps. Just management fees, obviously, with the FER will be higher with trading. So you can do the math as to what it turns out for your portfolio, but obviously that will matter a lot when we have products within ETF space that will have an FER of 7%. And those are going to be, when you put that in front of a client, those are going to be quite hard to explain because they will now be shown as a percentage and also as a dollar amount. And those are going to be hard to swallow, I'd say.
Yeah, so I think it's a good initiative in terms of providing more information to investors. And I think it'll benefit the industry overall. So it'll benefit the investors, but it'll also benefit the providers that are, giving transparency into the strategies that they're offering. So Andres, any other thoughts that you'd like to leave with us in closing today before we wrap things up?
Yeah, what I'd like to say is that, this year we had record flows, and we've had record flows, and we've also had record number of launches. This year was highlighted by a couple products that are new, like there's 75 single stock leverage cover calls. I don't expect there to be 75 next year. We see that number lowering. So the number of 367, let's say, products might scare a lot of people coming to the space. I'd argue that there's over 10,000 mutual funds out there. So there's a lot of runway in ETF land, but I don't think next year we might get necessarily that high of a number as we had this year. But look, we're going to see the natural migration out of the mutual fund space into ETFs. And because of that, we're going to see a lot more active in the space going forward. We're going to see a lot more launches going forward as those fund managers want to launch the same strategies in ETF form. So the same will happen in the US with the ETF share class. So active will be the name of the game for the years to come, especially when it comes to launches.
Andres, thank you so much for making the time to be here with us today. And thank you, as always, to our listeners. Don't forget to tune in next Thursday as well.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.